Okay, can you hear me now?
Yeah, very clearly.
Good afternoon. Um, Pulling up my documents. We've got a lot to discuss today. Yeah. Okay. Hey, good afternoon.
Hey Daniel, good afternoon.
We're waiting on Samuel. Kevin has an exam, I think. Where should we start? Let's start with fruit. I'm going to share my screen. Understood. Sorry, I'm in our office. But I'm using my big screen, which I don't normally use for sharing. So hopefully this isn't all stretched out when I share it. Okay, can you see this okay?
Yeah.
I wanna quickly run through this and it'll make sense why in a minute. So this is an old deck for a company called Troop that we are talking to. Went back, this is from like 2024. And honestly didn't pay much attention to it when it was shared with us. But because of some stuff going on now, I think it's really important. So we are going to go through this deck together as if we are making a decision on if we're going to meet with a company. Right? Okay. I'm just going to slowly scroll and sort of call some things out. Right? So initial slide, messaging and positioning. Still don't know what the company does. Slide number 2, product marketing seen as a dark art, but it shouldn't be. So they do something with regard to product marketing and making it better. Still don't know what they do. This is not a good deck. I'm saying that now, not a good deck. Gone through 2 slides, don't know what they do. Vision. Empower every org and its people to say the right thing. Still doesn't mean anything.
It doesn't matter.
But they do point out, I guess, different parts of a product marketing platform and what they think is important. So, okay.
Now, please, can you make it to be bigger?
Make it bigger. One sec.
Perfect.
Samuel, I think there's a way to expand your screen for like the side that Daniel is sharing. I don't know if that's helpful.
Is this any bigger on your screen?
It's bigger now.
Yeah.
It's
Give me one sec just to. Shit. I'm just adjusting the rest of my screen accordingly. Got it. Okay, so they say some stuff that's important, and they go to team. So we are like we're almost halfway through this deck, and we don't know what they do. They did some product marketing stuff. Here's a team. Okay, experienced product innovators. Pindo, Revcast, Fifth Season, New Ambit. Do you guys know any of these brands?
I'm familiar with Pendo.
You know Pindo? Okay. Yeah.
Yeah. In Raleigh.
In which one?
They are in Raleigh, right?
Ah, yes, they are in Raleigh. Right.
Right.
So like, this is a horrible deck. Let me be honest. This is a horrible deck. They gave us some people, but we don't know who these people are. And they say they have experience. We don't know what their experience is here. And then down here, it says they have support from a team at 24 and up. They don't explain what 24 and up is. And then they name some more people. But then this is where they try to get you, right? They say repeat founders. They've done 12 startups across them, raised 300 million. Sort of impressive, very vague. They've grown teams from 0 to 500 and revenue from 0 to 100 million. That could be impressive. I don't know if that's everybody in aggregate or just one person, but okay, right? Oh, look, now we get to the problem. Okay, so is our messaging working? Basically, are they on message? And for what works, how do they replicate that? And basically saying that for SMEs, everybody's doing it poorly. I still don't have a great problem statement here, but okay, some sort of messaging or like marketing is done poorly. They mention like an anonymous small business. Cool. And then they say they have a solution. Which is not clear, but it looks like value props. Okay. Achieve metric visibility. Don't know what that means. Manage assets and sales interactions at scale. Sort of know what that means, but not super clear. Reduce sales cycle length and push deals. This, I know what that means, and this is like super important in marketing and sales. Increase conversions across buyer journey. Okay, you know what that means. That's important. Reduce cost per MQL or SQL. Don't know what that means. Improve close rates. Know what that means, but they don't say how. None of this says how, right? And then they mention their ICP, which, okay, sort of makes sense, but not very descriptive. Early traction. They mentioned some companies. They don't have any metrics. And they give us like competitive landscape, strategic roadmap. Oops. I'm gonna quickly move on. And then sort of their go forward plan. Okay, after viewing this, I have two questions. Like from a screening standpoint, does this meet our thesis?
Maybe.
I think so. Like if we just go with the basics that we were looking at, I don't think I caught where the company is based in, but otherwise like the check size and B2B, those check boxes are ticked. So just from a quick, like, does it meet our thesis standpoint? Like it does.
Got it.
But
And
as you mentioned, the deck is not that great.
to your question, they did not mention where they're located. So if we don't know where they're located, how do we find that out?
I would just look at LinkedIn where the founders are.
Got it. Does somebody want to do a quick check?
Sure, I can go ahead. Austin Webb, right? I got that for Austin Webb.
Yes, that's the CEO.
Raleigh Durham, perfect. North Carolina.
Nice. Okay. So they meet thesis. Cool.
Yeah.
So those boxes are checked. Next question. Is this an interesting business? We don't really know enough about it, right?
Yeah.
is there anything you liked about the business?
Yes.
What did you like?
The fact they have like they're experienced founders. They've raised so much money in the past. They've operated. They've actually operated over 10 startups in the past. I think that gives them some credibility.
Okay, experienced founders. Anything else? Okay, competitor. I can scroll to competitors. Is there anything else we like? Not really anything else we like. Cool. What concerns do you have about the business from what you see?
Sorry, Daniel. Um, I thought it was a concern that all their, like the landscape is all big names, but it looks like what they're showing is that in product marketing, there's no other player. So if that's true, then I think it's a good investment because the rest of the landscape, like companies like Notion, Gong, like we know those just blew up. So that's why I was asking you to scroll to this page because initially I thought it's like demotivating that they have to go compete with Monday.com and Notion and Asana. Like at that point, I wouldn't invest in a company. But if they're saying that there's no other player in the product marketing space, then it looks pretty attractive.
Got it. Okay. Yeah.
I think one thing that is kind of a red flag is there's no storytelling behind like their company. Like there's no story. So they didn't like craft their story very well. So I think it just needs to like probably do a better job at telling the story because Shaker found us because you've been working on like the whole competitive landscape for Lineage. Well, if someone is just looking at this for the first time, like you wouldn't even like notice this.
Yeah. No, I think this is an interesting case of like probably an interesting team saw a problem somewhere, built a technology, and hasn't quite figured out how the tech fits with the problem. That's sort of what this looks like, right? And granted, this deck was made over a year ago. This deck is the next company we will be doing diligence for. I need to get updated materials. A lot has changed with the business, and so I will go into more of that towards the end of the call because a lot has changed. But this is just a quick sort of gut check around literally the next deal we have to diligence, and there's a bit of a story behind it. Okay, so I'm going to stop sharing this now, and we just quickly ran through sort of what you guys have been doing at scale with our with that company list for all the companies you were reviewing. Yes.
Please, maybe if you're doing like if you're hopping on a call with these guys, can you add into the call also because I think I met Austin when I went for last year's Venture Connect in Raleigh.
Mhm.
Because I actually saw that I actually sent him a message telling him like next to connect during the conference. So.
Got it. Nice. Yeah, I'll let you know. Most of the because of where we are with them, we're a little bit past a lot of the like early conversations, but there's more to it. So let's cover that at the end. I wanted to take some time and go through this list. And so I think there's a few things. Right? We have as like venture capitalists, as junior VCs, there's a few things that it's our job to manage. A lot of time, we are the first line of defense when it comes to deals. Deal screening, deal memos, deal diligence, like that's us. And the goal is for us as a group, you guys, to be experts at that, pretty good at that by the end of this semester. That's the goal. So that if you wanted to go out and do this as a job, you'd be fairly comfortable doing it, and they wouldn't have to teach you from scratch. Part of that is sort of prioritization. And I wanted to hit on that because I think it's something that I struggled with early on. And it's the idea of, I have these 3 or 5 tasks that I'm working on. One is a deal, one is some market research, and then I got this like deal screening stuff. And deal is always like number 1, right? Market research tends to have a pretty clear timeline as well. Whereas deal screening rarely has an end date that it must be done at, because it's sort of continuous. And so it tends to be the lowest priority item. What I want to hit on is, yes, the deal screening technically is the lowest priority item, but there needs to be a cadence to getting the deals screened, because I would think of it as a funnel with water coming in. And the water does not stop collecting at the top of the funnel if I slow down, right? If I do fewer deals today or do screen fewer deals this week. So though it is technically the least important part of our job, or the lowest prioritization wise, it's important that we're always finding time to sort of like get through a few on a periodic basis. My pace, and again, I do this full time. I don't have classes, but it is like 50 to 100 a week, sometimes more, right? Where we're just bam, 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 and it could be 10 a day, give or take, and you just knock them out in like 30 minutes, right? And it's super straightforward. Does this fit thesis? If it doesn't fit thesis, I don't touch it, right? We move on. And that's partly how you can go so quick. So a lot of these, it's like they're sending you something from Turkey or Dubai, like not worth my time, right? And then the stuff that's more local, I tend to spend a bit more time on it to make sure it doesn't fit. But that's sort of what I wanted to mention, because this first batch is just the first batch. We have so many companies we're going through. Many of, and a lot of these were fairly shitty. Pretty bad companies, but the ones that are coming up, I know for a fact are actually pretty good. And it's just, I think reps really make this easy for you. The more reps you get, the easier it is. The more calls you jump on, the more comfortable you are talking to founders, and you sort of increase your ability to extract the necessary information you need to make a decision. So next step that I want everybody to start being a part of is jumping on the pitch calls, to the point where you can then run the pitch meeting right by the end of the semester. Does that make sense? So we're going to walk through some of these today, but just know like there is a never ending waterfall of companies to look at. Some really cool and interesting, other ones are total crap and will feel like a waste of time. Okay. Yes.
I was listening. I think I was watching like a YouTube video or like a podcast that has to do with VC, and they said that most of the deals most VC firms invest in come through either like syndication, or you're being referred, like a founder is being referred to the VC firm. And most times, like the cool emails are just dropping their pitch deck on like your website. That most of those things like they're not important. So I just want to know from your perspective, since you're the job, what do you think?
No, that is correct. Most deals come from somewhere else. Normally a warm intro, or you've known the founder for a while, right? Like if it's somebody that's a well-known person in the ecosystem, it's my job to already know them and to know that they're interested in starting a business and to try to jump on that before they go elsewhere. So Spider is an example of that. I may have mentioned that to you guys before, where the founder had started a previous business, sold it to Wells Fargo, took a really high up job, was leaving to start Spider. He knew Toby. Toby was the second call he made, right? And then we jumped on that and locked it down in 2 weeks. So yes, that's totally right. With that said, when you're a lead investor, oftentimes it's our job to go find the company. So I think of it there's two sorts of VCs. There's a lot of types of VCs, but I'm going to bifurcate it in two ways. One is lead investors, and one is sort of everybody else. When you're everybody else, what you need to do is try to get in the best deals, which means you're not setting the terms, you're tagging on to whatever has been established, right? And in those instances, it's really important for you to have connections with the lead VCs so that you could get brought in, or for you to have to be a well-known entity in this sector, right? So we can say, we want you because of your expertise in medicine, right? We will go to you for every health tech deal because you're great at getting us in the hospitals or whatever, right? You have some sort of niche. That is when it's hyper important, and like you're never getting cold emails really. Occasionally it happens, but you're not really considering those. For lead VCs, oftentimes it's our job to find opportunities before others. And so sometimes because of your name, because of your prominence in an area, people reach out to you first, hoping you will talk to them. My opinion on this is I talk to everyone. I talk to literally everyone. One, because if it's a good deal, I want it before other people. Two, it's a really good way to learn industries you don't know about. So I will take a ton of calls from logistics startups or construction tech startups. I know nothing about construction tech. I can't build worth crap, right? But after you've seen 10 or 20 of these, you start to have a really a good idea of what the market looks like and who's actually best positioned to win. So I think of it as sort of market intel you're getting, but also finding opportunities early. Now, the name brand firms tend not to take cold emails, but at the same time, they are doing screening like this of stuff that they find on their own and going out and saying, hey, I want to invest in you, taking more contrarian bets, right? And then they will pull in who they want to be syndicate partners if they need it. Okay, I have some deals from this list that I would like to discuss. So we talked about Troop. Who looked at Client Ramp? Let's see. Client Ramp.
Yeah, I look at it.
Okay, can you tell us what it does?
So Client Ramp, they're like a B2B SaaS, but basically for freelancers and different agencies. So they try to do, I'll say they try to automate like invoicing and approvals of invoices and receipts, those kind of things. And I think the ask was a $1 million of seed round. But
And well, what about the concept did you think didn't fit with thesis?
so first of all, I wasn't clear on where they were located. And another thing is the competitive landscape is like huge. They have companies like Monday.com, Asana.
But so before we get there, so as we're screening, the first step is it on thesis? Is it B2B? And I guess the answer is like, maybe.
Kind of.
Like technically these are small businesses, maybe, even if they're single person, right? It may be a stretch, but let's say, cool. But we don't know where it's located. So then I would throw that back to you and say, Samuel, you got to find like where it's located, right? Before saying it doesn't fit thesis. And maybe it doesn't, right? Maybe they're in, California or something. But I would start there, because as we move quicker, It'll be a quick
Okay.
check for you, and then, hey, we don't need to touch this anymore, right?
Okay.
Or it does meet thesis, and they're in Durham. I don't know where they are. I have no idea where they are. And then I'd say, if they're in Durham and they meet thesis, we may have a call with them, even if it's a bad business, just because they're local. The other thing I'd say is the questions that you have in mind, right? So like the questions, the way that I think about this is the questions that you put here are some of the most important questions we're going to discuss with them when we hop on the phone, right? And so ARR and users, like traction, is something we're going to want to hit on, but I'd say we want to go deeper than that. And so what could that look like is right, like we do care about what their revenue is and how many users they have, but maybe specifically, because I think you mentioned they just launched their MVP.
Yeah.
Early users and free trials in play, right? Okay. So what matters here is churn, right? Retention and churn. You just launched. How many people stayed with you?
Yeah.
What percentage of people are actually paying for the product? Does that make sense? Right?
Absolutely.
Like we do care how much money they're making, but it's super early, so it's going to be negligible, right? And we do care about we do care about how many users, but what percentage are paying? How long have they been on the platform? How many dropped off after 30 days or so? If this is a monthly subscription, right? That gives you an idea of like time to value, how long it takes for it to become valuable to people, and then stickiness of the platform, right? So what percentage are sticking around? I'd say for a super like SMB prosumer, I would call it, type of customer, a lot of the metrics you track are very similar to B2C businesses. But I think the biggest issue the team would have, and the thing that we would hit on with a business like this, is churn. If you found a business with like super low churn, despite it being super SMB, it could be really interesting. The issue is most of these have extremely high churn, where you're paying a ton of money to acquire customers and then losing half of them every month, which is not sustainable.
Just
Okay.
to add that the CEO is in Kari.
I wanted to ask about another company as well. Fairway Control. Let's see who has.
Yeah. I looked up Fairway Control.
Okay, tell us a little bit about what they do.
So they are basically a SaaS company that manage end-to-end operations for golf courses. So first step, I feel like it did fit our thesis because it is B2B, like they would, like their customers would be golf course managers.
Mhm.
So it's B2B.
And in the Southeast?
They're based in Florida, so like sort of Southeast, kind of
Good.
extending it. But I just think like Florida is a good place to have a company that just deals with golf courses. Like, so I thought like it's a good way for them to, start building their partnerships just being in Florida. Check size, they're looking for pre-seed, max $750,000. So again, fit our thesis completely. I just thought it's a niche market though, just having operations with golf courses. And like I don't know much about the golf course industry, so I'm not sure if this is even a pain point. Like right now, most golf courses are in country clubs or um like bigger golf courses. I don't know if they have issues with operations and how a SaaS software would resolve it. But I still mentioned that we should schedule a call because it plainly fit our thesis. But like you mentioned, like retention might be a problem for them because if just onboard golf courses in the beginning, by giving them a lot of deals and handling everything for them. But those deals are going to end at some point, and at that point, retention might be an issue. But I think that's also a little later issue. Like in pre-seed, I am not sure if like we're thinking about retention. But you just mentioned that we should be thinking. So
so retention would be less of an issue for a company like, not less of an issue, but less of a focus area for a company like this, given the nature of these softwares tends to be annual. So it depends on how they think about this, right? And what the company decides to do. If it's an annual contract because of its size, retention, not that it doesn't matter, we're just not going to have any data for a year, right?
You're right. I think it was an annual contract.
But what I heard in you as you were speaking about this is you have questions about the pain point, like is this a cure or is this a vitamin, right? That type of question. So that would be the sort of thing you'd include in your question set. And then also around competition, right? How busy is it? What is the status quo? What do you already, like that sort of thing. And so those are areas you'd want to hit on in your first conversation with this company.
Okay.
Cool. So then I will, the other thing for like, if TAM is a really big concern of yours, I would do back of the napkin math. I would say how many, it's like, but super quick. So like I take 5 minutes and say, how many golf courses are in the US, right? I'd like Google. Let me see what Google says. Google says 17,000 golf courses. Okay, doesn't mean much to me, but 17,000, right? Did they mention pricing at all in their deck?
They did. I'm trying to pull it up right now, but they definitely did mention it.
Got it.
Let me pull it up. The mistake we're making is we didn't rename the folders with the company name. Okay, I found it. So they mentioned $375 per month per golf course and $4,500 per year, and they apparently have 85% gross margin.
So wait, it's 4,500 a year, and an extra 375 per month, or that's
no, it's either 375 per month or
got it.
4,500 a year.
Okay, cool. And what does that give us? If we do 17,000 times 4,500, that is 76.5 million.
Yes.
Okay. How do we think about that market size?
Not as big, right? 76.5 million is tiny.
That's right. So probably not for us, right? And so that you can just do like super quick back of the napkin math to get you your answer on TAM.
Okay.
Cool.
I did think it's a niche market, so I mentioned it in the cons. I should have done the math myself.
Yeah, no worries. Okay. Cool. Right. So I'd say we're just we're going to do a bunch of these, but getting reps is how we get better, right? And see, the more companies we see, the more comfortable we get with this, the more practice we get. We're around time, 1:35. Do I want to do one more? Giancarlo, you had done GovDoc?
Yes, I did GovDoc.
Did we talk about it last week?
We did talk about it last week.
And we didn't like it because why?
We felt that the market for it was a little bit uncertain with changes in federal funding and state funding, and kind of like I had put in there that I didn't like it sounded like a good value prop, but it's something that might be going away if there's less federal funding.
Makes sense. Somebody emailed me about them this week, and I was like, familiar. Sorry, through. Okay, cool. No, thank you.
Serious though, they weren't. Was
They're going after it.
so.
Okay. Everything is done on Lineage except market size, and working with Kevin on that. Note, Kevin's also building, he's going to try to build a pro forma cap table. So, do you guys know what a pro forma cap table is?
Yeah, I think I have an idea.
Okay. Well, Samuel, share with us what a pro forma cap table is.
So anytime you hear the word performer, it's a what if analysis. So it's trying to build a scenario whereby we invest in a company and get on their cap and like get on the cap table, that kind of stuff.
Nope, that's right. That's right. It's basically what it's projecting what the cap table will look like after the round, right? How much ownership we will have. And this is important because a lot of times we will do, you could just do the math in your head about, if we invest $1 million at 9 pre, we have a $10 million post money, therefore we own 10%, right? And it's like super simple. And we do that, and that's very useful. But what also tends to happen is things are more complicated than they look. So oftentimes we may say we need option pool, an employee stock option pool, right? So as you hire early employees, you can't afford to pay them like Meta or Google. So instead you give them large amounts of stock in addition to their pay, right? And this all dilutes us. Sometimes that stock option pool will be put in before we invest, almost always before we invest. Occasionally, if negotiated, it'll be put in after we invest, and that can dilute our ownership. And then ownership changes over time as we have more and more funding, right? We're going to be a smaller and smaller piece of the pie. And so though we come in and we own 10% initially, we may not own 10% at time of exit. And so you can sort of project things out over time. Oftentimes, we only do the current round. If I'm running a deal myself, I tend to project out towards a series A or B as well. Assuming you raise that price, we invest another $1 million or $2 million, right? You could sort of get an idea of how our ownership is impacted. At some point, we'll walk through that as a group, or one of you may be asked to do it. Maybe I'll ask Kevin to share it when we're done with it. Okay, cool. So that's Lineage. Aphora. Let's talk Aphora. So based on the conversation with Daniel, and then additional time spent thinking about or reading about the space, where do we sit? What questions do you have? What are your thoughts?
About the offer, I think Daniel really understand about the market. I and John are trying to provide him with useful information, but I feel like his focus is more likely about like how to acquire the new brokers. That is the things that I'm concerned as well, because I feel like I'm not in this industry, so sometimes my recommendations could not be very useful for him. So that is what I'm thinking about.
Got it. Well, let's think about the brokers for a minute. Are there different types of brokers?
I think there are two main types of brokers. The first one is national brokers, and I believe that Daniel knows everyone in that list. And the second is regional brokers. So I listed out more than 20 brokers, and I really want to see his feedback. If he's want to get more information, I will try my best to provide more. Until now, I have the short list, and I don't know whether it meet his requirements.
Got it. Got it. Okay. So you got a short list and focus on regional because it seems like that's where his knowledge is lacking or that's where his insight is lacking. Um, I think that's totally appropriate. So then I think next up there would simply be shooting him a note saying what you shared with me. Hey, you seem to have international brokers on lock. We'll leave that to you. We want to focus more on the regional brokers that you probably don't come in contact with as much. And this is sort of a first set that we are thinking about. Does this meet your criteria? If yes, awesome, we'll continue. If no, let's discuss what's not working there, right? Yeah, I think being like super pointed with like, is this what you need or is this not what you need? And sort of building off that goes a long way. Cool. Anything else that you guys are thinking about around Aphora?
I think one thing that Sun did a really good job, but I didn't know if we should expand on it, is like identifying like target people to reach out to, because we on the list there's like, this person is the pharmacy, you know, benefit manager for this national or regional company. Like, okay, we can have their LinkedIn. We found this AI that lets you put in like the name of a company and it spits out like what their like basically like what their email should be.
Yeah.
And like, you know, do we want to get a list of like, okay, these are all the people you should email?
Got it. I would hold off until he confirms the companies. I don't want you to waste your time finding people, then he says like, no, the company's not the right one. So cool. Okay. Then I will leave it to you guys to put together an email for Daniel and just let him know sort of, this is what we have. Is this on track? If so, awesome. We'll keep going. If not, help us or guide us in the right direction. Cool. Okay. Okay. So I want to go back to Troop because that's going to be the next deal we do with the team. Let me give you the backstory here. So I'm moving my screen around. Backstory here is Troop is founded by a startup studio or an incubation studio. So the people you saw here, this team, like Austin, Nathaniel, Jennifer, whatever, they're fine. They're sort of whatever. What we care about is this guy here, Eric Boduk. Eric is one of the co-founders of Pindo. Pindo is a huge unicorn software company. It's been around for forever. It's Raleigh based. They've sort of sucked up a lot of the local tech. And because they've been around so long, what's ended up happening is the management team has sold off a decent amount of their stock in secondaries and gone off and done different things and brought in professional operators. So the people, a lot of the, like, I think there were 3 founders initially. 2 of them have left and they're doing other things now. And one of the things that Eric is doing is he's building a startup studio and he's raising a fund around it. And Troop is one of his companies. The first company is called RevCast. Second company is Troop. RevCast is more RevOps management, which is like super niche but important part of high growth startups. They are backed by Charles River Ventures, a really like great tier 1 firm out in Cambridge, Boston. Company hasn't really worked out. We looked at it I think a year ago and it just didn't. It wasn't growing like we would need it to to have grown. So we passed on it. Troop is sort of the next one. And what we've told them is the business as is not great. Like we don't love the business model. We don't love the value prop. A big part of that is the marketing focus. So David from our team, like this is a space he's an expert in. He thinks it should be sales driven. And if it's a sales focused business model, if it's a sales focused product with a more sales focused business model, he thinks we could have a lot of success here. And so what we're actually doing is partnering up, and we're not lending David out, but David's basically like restructuring the business, restructuring the product. He's like tearing it apart and putting it back together the way he would do it. And then he's going to hand that off to Austin to run with. Now you're like, okay, what does that mean for us? We're not investing out of Fund 4 yet. We're still in Fund 3, but this is so early, this can't be a Fund 4 company. Or this can't be a Fund 3 company. Because it's just gonna take so long to get this off the ground. So what's happening is there's this concept called There's this concept called warehousing in venture. Warehousing. What is warehousing? Is basically when you're raising a venture fund, but you don't have the fund yet. You want to have deals you can point to that you're gonna do once you raise the money. Does that make sense? Right? You want to be able to point to deals so that when you're talking to people, you can say, yes, I have this deal in my pocket. As soon as I get the money, this is the first place. This is our first investment. We don't normally do that, and you don't really need to do that in later funds. It's really useful if it's your first or second fund because nobody knows your type of company. Nobody knows how good of deals you can get into. What happened here essentially is they're raising now, and we would like to lock down our position for later. And so what's been discussed is we're going to put in $100,000. More like the partners are going to put in an angel check of $100K. Now, with the idea that once we launch Fund 4, we'll have like 30 days or whatever to have an option to put in $1 million or $1.5 million or $2 million into the company.
Sorry, quick question. What's the $100,000 for? It's just like we want to reserve our spot for when our fund closes.
They need a little bit of cash. So like they want to raise now. And what we're saying is, hey, we don't want you to raise now because we can't give you $1 million now. Right?
Okay. So this would stop them from raising funds now, because my thought was if they raised right now and we put in our investment when Fund 4 closes, that would dilute the shareholders that come in this round, or like the investors that come in this round, right? Like
it would, but we'd have to come in at a higher valuation.
Oh, right? That makes sense. So it would be a next round sort of a thing.
Right. And so we want to invest in their seed round. If they raise their seed, we'd have to wait till the A, right? Which is much pricier. So we're putting in enough to get them through the next few months such that we can put in the check that we want to put in and give them the growth capital they need. So this is not a normal deal that we're doing. So part of our diligence is how things are today. And we're going to be working on that. And it's going to be, should we write a $100K check? Second part of diligence is like, what do we think things are going to be in the future? And like, what bars does the company need to meet in order for us to still want to put in $1 million or 1.5 or 2 million? So there's been a lot of conversation back and forth. They are interested in having us. I think the team wants to make the investment. Cool. The team wants to make the investment. And so one of the open questions that we are discussing is, how do we price a future round that we aren't promising we're going to be in and where we don't know how much traction they're going to have? Does that make sense? It's sort of a weird thing, right? And we're pricing for later today so that everybody's comfortable with the deal structure. And so with that, I thought it would be helpful exercise to walk through with you sort of how I'm thinking about this. So this is the round that they are raising. They say they want 2.5 million. Fine, but right, if that's how much they need, that's how much they need. I think ideally we would want to invest about 1.5 million. And where are they in traction? They have a little bit of traction, but not much. It's negligible, right? It's 100K, 150K or something, if that, right? So they don't have a ton of traction. How do you guys think we should value this company? It's okay. You don't have to have an opinion on this.
No, normally, I think there's two things we can do. The first one, we need to have their revenue projections, so we can see like when they go to the next round, how many revenue they can generate. And the second one, we should look into the comparables deal, like in the market. So with some companies in the same round, like this is a seed round, right? And how many multiples normally they have, and how many revenue they have generated, and it's like something we can look into to refer to apply the multiple to the revenue projection.
So you're partially right there. I'd say for a seed round like this, like revenue projections don't matter because nobody ever hits their projections. So we can't trust them. Either they like miss them by a bunch or they overshoot them. It's pretty crazy how like wide the difference is. So we will do revenue projections for them, but it won't be the basis of our valuation. Comps are helpful. Do we keep a literal database of comps? No, we do not. We should, and I've told the team we should, because that would be useful. But because we see so many of these deals and we do so many, we have a very good idea of what the going market is. And sometimes they talk about valuation being sort of part art, part science. I'd argue for this seed round, it's more artsy than it is sciencey. The most important thing for us is ownership and wanting it to fit our portfolio structure. So the team has sort of decided they'd be comfortable investing $1.5 million into the company. That's the number. Could they flex up or down? Sure, but like back of the napkin math, that would be the ideal number. The other thing is, from a valuation standpoint, the median seed round is going for, let's say, somewhere around 12 million pre-money nationwide. In the Southeast, it tends to be between 5 and 9 million. So we want to come in at like a 5 million pre-money. They're going to ask for, 12, 15 million pre-money. We tend to stick pretty hard to our guns around our valuations. Lower valuation, higher ownership is where we want to come in. Ideally 15 to 20%. So if we know we want to put in 1.5, we know they want to raise 2.5, and we know that we want to own 15 to 20% of the business. What should the pre-money be for this business? Like that's sort of what we're solving for. And so we can say, if we're going to make it super simple, this should be 10 million post money because they want to raise 2.5. So they're going to sell 25% of their business. 10 million post money valuation means if they raise 2.5, pre-money is 7.5. We'd be 1.5 million of that. That's 15%. They have another group that wants to come in for 500K, and then they have about 500K worth of safes, and we'd argue that should just convert into this round. The safes should convert into this round. So functionally, they would have raised 2.5 million as a part of this round. We'd own 15%. Okay, 15% of the business is not bad. Okay, so then if we own 15% of this business, we're looking out now, and this sort of goes to not necessarily revenue projections, but to how big this business can be, or how big we need this business to be. If we own 15% of the business at a 10 million post money, what does this company need to exit for in order for us to return the fund of $50 million?
you repeat your question? I'm sorry, I missed it.
So if post-money valuation is 10 million, we own 15% of the business because we wrote a $1.5 million check. How big does this company need to be in order to return our fund of $50 million?
300 to about $400 million.
100. 100.
I got 333.
Yeah, 300. So
That is the right number. How'd you come to that number?
50 divided by 0.15.
yeah,
That's right.
okay.
Right. So this is and so this is more, I call it back of the napkin, right? The simple math that we structure our thinking around to figure out round dynamics and what the opportunity is. Right. So then it's going to come down to us as a team, and I'll send assignments out later, to figure out in this scenario, right? Like, how big do we think this market can be? And what percent of the market do we think Troop can get? And if it's, if it's basically 350 million or more, we're probably in business. If it's less, we're having a serious conversation.
We learned this method in the class as well. We just learned it.
Yeah, yeah.
It's named sweet spot.
Sweet
method.
spots. Yeah,
Very cool.
sweet spots method.
Right. And it's because, I think the nature of these early rounds is like, is it competitive? And then how does it fit in the portfolio? And
Yeah.
unfortunately, it tends to mean you're forming the roundabout around what the VC needs rather than what the company needs, but you're sort of trying to meet in the middle. That's all to say. We're going to be seeing a lot of Troop. I'm going to see if I can get an updated deck for us that's more focused on where they're actually focused on and where they're going. But I think this has been a good practice around, one, we've screened the companies, you figured out what you like or you don't like about a company. But then as we dig deeper around, should this be a real opportunity for us? How we as the associates, right, analysts or associates, need to be thinking about the deal, right? And how we can enter from a valuation standpoint and an ownership standpoint and what we're targeting and how big the business needs to be in order for it to be a winner for us.
Okay, thank you so much for this meeting. I think it's very
When do we
insightful.
expect, when do we expect to get an updated deck?
Whenever they share it with me. I've sent them an email.
Okay.
So hopefully we have an updated deck. But I will say, even the deck that we do get may not be the most illustrative of what the future business will be.
Yeah,
It will be better than today.
because David is cooking.
And David's about to go on vacation to Europe, so hopefully he gets them whatever they need before he goes on vacation.
Okay.
Cool.
Thank you. Thank you so
Yeah.
much.
Okay. Thank you, Daniel. I have to run
See
to
you
class.
later. Yeah.
See you guys.
Yeah. Bye bye.
Bye.